Hi, I'm Jimmy. In this video, we're looking at Tesla's stock, but not from the perspective of their business and is it worth buying, but I've been asked a few times recently to analyze Tesla's stock. And when I started looking at some of the numbers, it was fascinating to me how impressive of a company Tesla is, but also how it could have hurt many, many investors. And that led me to want to make this video, which is really more around why buying a stock at a good price is very important, even if you're buying a great business. So many people might have heard Warren Buffett talk about Ben Graham or Mr. Market. And here's one quick snippet of from one of his Berkshire Hathaway meetings where he talks about that.
The beauty of stocks is they do sell at silly prices from time to time. I mean, that's how Charlie and I have gotten rich. You know, Ben Graham writes about it in Chapter 8 of The Intelligent Investor. You know, Chapters 8 and Chapters 20 are really all you need to do to get rich in this world. And Chapter 8 says that in the market you're going to have a partner named Mr. Market. And the beauty of him as your partner is that he's kind of a psychotic drunk. And he will do very weird things over time. And your job is to remember that he's there to serve you and not to advise you. And if you can keep that mental state, that all those thousands of prices that Mr. Market is offering you every day on every major business in the world practically, that he is making lots of mistakes. And he makes them for all kinds of weird reasons. And all you have to do is occasionally oblige him when he offers to either buy or sell from you at the same price on any given day, any given security.
So in that clip, Buffett is talking about how Mr. Market is offering us prices, some high, some low, but that matters. Where we buy matters. We don't want to just take whatever price and imply that this thing's going to go to the moon or whatever it is. Stocks are they're going to revert to the mean, revert to the actual numbers at some point. Now, to illustrate, we're actually going to jump over to the Investors Grow website. So this is the Investors Grow website, and we built this site to try to make it a little bit easier to value companies, analyze companies, things along those lines. But for now, let's jump in and look at some of the financials for Tesla's stock. Specifically, we're going to start with their revenue. Now, I'm going to zoom in a little bit more than we have right here, just to make it a bit more readable. So although it may not look like it, all this analysis is done on the Investors Grow site. Okay, so this is Tesla's revenue going back the past decade. And as you can see, it is ramped up a ton. But over the past few years, the numbers have ramped up significantly. In fact, it's up more than 200%. This is revenue, more than 200% starting at the end of 20. So if we were to look at 2020 to today, revenue is up 207%. If we were to jump over to profit, well, for a while in the early parts of the decade, company wasn't profitable. New company, young company. A lot of companies weren't quite profitable just then. But again, starting in 2020, well, the numbers ramped up a ton, up almost 2,000%. This is net income. Similar story when we look at earnings per share, which is net income divided by shares outstanding. Numbers aren't exactly the same because of some issuance or buyback of shares, things along those lines. But again, earnings per share is up almost 2,000%. So when we're looking at the fundamentals of the business, if it's back in, let's say, the year 2000, and we're analyzing Tesla, we're looking at this. Let's pretend we could project that and we could say, listen, I love this company. This company, if you had a crystal ball back in December of 2020, and you could say, when all the numbers come out over the next few years, this is the way their numbers are going to shape up. Well, this looks like a fantastic buy. And I think that this is where the potential landmines are. This is where many people see this type of thing, or they maybe see a single quarter where they have numbers were fantastic, and they believe that this is going to happen. And let's imagine in this scenario, they're right. This is exactly how it's going to play out. By the way, these are completely real numbers. This is exactly how it played out from December of 2020. If you were to fast forward all the different years, the numbers actually played out like this. But the next most important piece, the piece that Buffett was talking about, well, what is Mr. Market offering Tesla stock to us? What price are they offering it for? Now, there's a whole bunch of different ways to value companies. I'm going to keep this simple. And with Tesla, I'm going to go through some basic examples. This is a chart on the Investors Grow website, where it's a historical chart of their price to earnings multiple. Well, in December of 2020, right here, Tesla's stock was trading at 700 times earnings. Now, just so we're on the same page, price to earnings multiple is how much are you willing to pay for $1 of earnings, $1 per share. So let's pretend, in this case, 702x, that means we're going to pay $702 for $1 of earnings. Now, the initial hesitation is people might see that and say, yes, will I pay $700 times earnings if I know earnings per share is going to go up 1,800%? Okay, something to consider. But now let's jump in and look at a different valuation method. Right along the top here, these different tabs. Now we'll jump over to enterprise value to sales. This is the market cap of the company with debt and cash included. So, it's a more all-encompassing look at the business itself divided by revenue. Sales revenue, same thing. Well, again, in December of 2020, this is a 5-year chart now. I zoomed in a little bit to make it easier to see. Enterprise value to sales was trading at 17x. The issue that we have with it, if you look at these horizontal lines are the averages. Well, not long before that, this very same company, Tesla, was trading at 2.6 times sales. So you'd pay 17, again, in our imaginary scenario, it's December 2020, and you could pay 17 times sales, or you could have paid 2.6 times sales. And again, you'll see it kind of drop down there afterwards. Well, what about enterprise value to EBITDA? When we look at enterprise value to EBITDA, as you could imagine, 129 times EBITDA. EBITDA is a number on the income statement. So enterprise value compared to that particular number on the income statement, why would we want to pay 100, despite the fact that we can look out into the future and we have supreme confidence that this company is going to grow that well, 1,800%, 2,000%, things along those lines. But even looking at their own historical average, this is why we put these charts on the website for all the different companies, because why would we want to pay 129 times EBITDA when the year before we could have paid 25 times EBITDA? Again, just something to think about. Now, what about something like price to book value? Well, here, for Tesla stock, it was 30 times in December of 2020, 30 times earnings, or 11 times earnings not that far before then. Now, obviously, the real question is, well, how did all this play out? Well, if we bought in December of 2020 and we held that stock for 2 years. So as you can see, we got these custom dates down here. So we started at the end of 2020 and we went forward 2 years to the end of 2022. The stock was down 47%. And I just want to, again, keep in mind that this 47% drop here happened while revenue, earnings per share, net income were going sky high. The numbers were skyrocketing, and this stock is cut in half. Now, what if we had held it a bit longer? Well, if we had held it a bit longer, let's say we went to the end of 2023, now it's up. Now we're up 5.6%, which again is, of course, better than down 50%, but 5.6% for a 3-year period. And over that 3-year period, earnings per share is up, 1,800%. That's a massive discrepancy between those two numbers. And then if we're curious, if we fast forward to today, so we bought the stock back at the end of 2020, we held it to today. As of the shooting of this video, it'd be up about 3.8%. So up a little bit. Annualized, that's up, 3% over about 3 years. So about 1%, a little more than 1%. Again, not a great return considering how the obscene growth that the company, the fundamentals of the company actually showed. Now, just so we're on the same page, I didn't cherry pick the highest point. In fact, that was the highest point over the past couple of years. And obviously for the people that bought in there, they didn't do nearly as well. But this isn't just true for Tesla's stock. I think Tesla's an obvious one because their revenue numbers and their earnings per share numbers have gone absolutely sky high. But you can get a company whose stock has gone up, and this buying companies at a good price matters a ton. Let me give you a quick illustration where in almost all scenarios, it did fairly good. So this is Microsoft's price to earnings multiple going back the past few years. here's the thing. If you bought it, again, right around the same time period, but you bought it here at 34x. So that was back in June of 2020. You could have paid 34x. Now, if you had done your analysis, if you research a company and you say, hey, I love this stock. I personally had researched Microsoft and I really like the company, but around that time, it looked a bit overpriced. Well, if we had a bit of patience and we waited for Mr. Market to give us an irrational price on the downside, well, over here, price to earnings for Microsoft dropped to 24x. Again, this is fairly impressive. The long-term average for the S&P 500 is about 20x. So Microsoft, which is one of the better companies out there, trading at 24x, especially considering that compared to their own historical averages, it was significantly overpriced. And now when we jump over, look at a chart of Microsoft, well, we can see that if we had bought back when it was trading at 34x, well, up at the top here, we can see that our total return is over 100%, which again is impressive. This stock's up 19% on an annualized basis. This is if we paid 34x from a price to earnings perspective. So you're up 19.3% annualized. So on average, your average annual return, 19.3%. The stock market's average about 10%, so you're killing it. But the interesting part is you bought it right here. At that time, the earnings per share was a bit under $6 per share. Not too bad. But again, you could look at that time and say, okay, it's trading at 34x. What was the historical numbers look like? Do I want to pay this multiple? Is this a high or a low multiple relative to maybe the industry, relative to their own history? Is this a good price? Because here's the crazy part. If we had waited just a little while and we had waited for it to drop down to 24x, the stock got back to nearly the same price, except the primary differences at that point is when you fast forward it in time, now earnings per share is almost $10 per share. So the difference in return is huge because now you're paying 24x. And since that time point, the average annual return is 36%. So just showing what that chart looks like and comparing the two numbers side by side, we can see that although both numbers did good, there's a 16% annualized difference. The average annual return from the holding periods is 16% different, which is crazy better when you consider that if we had just been patient with the price that we pay, well, we could have done significantly better. Okay, now what about another company? What about a company like Apple? Well, let's imagine that we're looking at Apple's business and we're looking at it back at this time. It's trading at about 37 times earnings per share. Well, if you bought at that point, the average annual return would be about 19%. You're up 102% total return, 19% average annualized return, which is great. But what if you wanted to buy below, this happens to be the 10 and 20-year average for Apple stock. Now, don't forget, this is just a 5-year chart. Past 5 years, it's been mostly above it, but it has dipped down a few times. What if you wanted to buy it down there when it dropped below that average? What if we let that be our guiding point? Well, if we were to buy it down there, now we're returning 38% on an average annualized basis compared to 19%. Again, these are significantly better returns just for waiting a little bit. Now, I'm using this example because you might look at this and say, yeah, Jimmy, okay, fine. Technically, that's true, but you're using all annualized numbers. What about the fact that the lower multiple one has a 75% total return and the higher multiple one has a total return of over 100%? First of all, both beat the market. So good for you for buying the company at buying a great company. But that's a fair point. But what if you bought it before all of that happened? If you bought it back before, the big jump in 2020, or the big jump in PE ratio, well, back then, if you'd bought it then, now the total return, again, buying it below the long-term average, is 27%. Total return is 200%. Average annual return is 27%. You picked up a bunch of percentage points if you buy the stock too high. Buying companies at a low multiple is generally a significantly smarter move once you've analyzed the business and you've determined that the company is a solid company, the business is a good business. As Buffett has said many times, the goal is to find a great business at a good price. The red arrows are indicating bad prices. the green arrows are indicating good prices or at least better prices. So we can see that buying at a better price can have a massive impact on our total returns. Now, this can work for so many different industries. What if we go to like the banking industry? You got a company like Bank of America. First of all, on the Investors Grow website, if you load up a bank, you'll see a warning like this. This green warning here pops up and says, hey, use price to book. Don't use something like discounted cash flow. For a bank, price to book tends to be the best valuation method. Same is true for an insurance company. That's why Buffett used price to book for so long to value Berkshire Hathaway, because they were predominantly an insurance company for a long time. So now jumping in and looking at Bank of America's price to book value. Again, you've done the research. Doesn't matter when you've done it throughout this time period. Let's imagine you've done it right here and you see that their price to book value is 1.4x. Well, we can look at their historical chart and say, well, is 1.4x, if I told you, hey, this company has a price to book of 1.4x, you might be like, I don't know, is that good or is that bad? I mean, who really knows? But looking at the chart, I can tell you this is high. If you were to compare that to just before that, it was trading at 0.7x. Just after that, it was trading at 0.8x. And now jumping over and looking at their price chart so we can see how it all played out. Well, if we bought Bank of America when it was at the high, right, of 1.4x, well, the stock from when we bought it till now is down about 4.2%. So we'll put that number right over here and keep track of it while we jump over and look at the next time period. Here we bought it for 0.7x. Now, during that time period, the stock went up on an average annualized return of about 15%. It's 14.9%, as you can see at the top there. Almost 100% return, 86% return during this time period. This is clearly fantastic. This is a beat of 19.6% for simply buying when it was below its long-term average. Well, if you fast forward and you happen to buy it when the stock was after the financial troubles were happening, the banking troubles were happening, and you bought it at 0.8x, well, now the average annualized return is almost 50%. It's up to like 44%, and it's been about a year then, so that's why the average annualized return and the total return are almost the same number. But again, this is a massive beat. This is a massive beat. It's up 44%, 48%. It beat it by. So this is a massive shift in numbers. And I think I wanted to bring this out and I want to show an example beyond just Tesla, because Tesla at this point might be a good buy. The PE is significantly lower than it was. There's still plenty of upside for a company like Tesla. But I really wanted to bring it out because I think it's so important. I think it's so important for people to, when they're analyzing their companies, analyze the business first. Go through the research for the stock. Do you like the business, not the stock price? Stock price will sort itself out. Kind of make a bullpen of companies that you like, a bullpen of a list of companies that you'd like to buy at some point at some price, and then wait for it to get there and see if it's the right pitch for you. Buffett has also said many times that investing is one of those games where there's no called strikes. You can just wait every day until you get what you deem to be the perfect pitch, and then you can swing for that. But I've seen, with my experience in investing and talking to many different investors around the world, I've seen that sometimes investors get so amped up about the possibility of a company, like we saw with Tesla at the start of this video, that they're saying, hey, this company's revenue is going to triple, earnings per share is going to go from $1 to $10. I don't care what price I pay. And that can have devastating returns. Now, as we saw with the Apple example, a Microsoft example, or even Bank of America example, you can buy it at a different multiple. You can buy it, you can overpay and still have good returns. But what I'm suggesting is that if you try your best to underpay, you can make fantastic returns. It can significantly improve your portfolio. Now, if you're curious how to analyze the stock, to do a deep dive, I actually did a video called 8 Steps to Analyze a Stock. And if you want to sign up to get access to the Investors Grow website so you can use these tools and try to simplify your investing process a bit, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.